Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Welcome back, Superclusters fans. A friend of mine once told me that success for most podcasts is predicated on how well known their guests are. Success for Superclusters, on the other hand, is predicated on how under the radar our guests are and the strategies folks have never heard of but make complete sense. Today's guest, Jay, is an excellent example of someone who should be on people's radar but has yet to hit the limelight. Jay Rongjie Wang, and that's spelled Rongjie Wang, W-A-N-G, runs her own single-family office, Primitiva Global. And when I say that is not the only term that describes her, I mean that is not the only thing that describes her. She was a published author by the age of 10, receiving fan mail that overloaded her physical inbox by the age of 12. She was a local anchor at the age of 15, a physicist by university, and a software engineer by graduate school. She's built scar tissue in public equities and as a tech executive before becoming an asset allocator in both venture capital funds and funds of funds. Her life story is a full-length Wikipedia article that needs to be written. And I will say, for this episode alone, we only get a small snapshot of it all. But if there are two things to triangulate the next hour towards, it'd be one, Jay shares the most raw, unfiltered path she took to get to where she is today, and especially helpful to understand the mental lens at which she came from before becoming an asset allocator. And two, how to build an LP strategy from scratch, and what the maximum number of funds one can allocate into before returns fall dramatically. Jay, I will be completely honest, ever since our last dinner, and I know this has been a long time in the making, I couldn't wait for this conversation. So nevertheless, thank you for coming on the show, and I'm so excited.
Me too. Thank you for having me, David.
I remember the first night that we met. We met at a dinner, and it was, I actually don't know if you were an LP in that fund. I happen to be an LP in that fund, which is how I got to know the crowd and all that. But we met for the first time, and we were chatting across the table, and I was like, in my mind, I was like, no matter what, I need to get Jay on the podcast. And lo and behold,
really?
You
Already?
brought it up first. I know. I was like, I mentioned, like, there's sometimes you vibe with someone, you have like a human connection with someone, and you know that no matter what else on the podcast, you're going to have fun. And I knew I was going to have fun with you. And we haven't even started recording it, but like, you know, I knew I was going to have fun with you. So Jay,
I feel so
excited.
Honored. Thank you for saying that. It's very kind.
So we could start in a lot of places, and I don't want to bury the lead too much for our listeners and our viewers. But I couldn't help but start in this place. And I gave you like forewarning ahead of time, so you knew this was coming. But I'd love to start the context of this podcast with probably one of the most interesting origin stories we've had on the podcast to date, which is most of your life before becoming an LP. And if you'll humor me, let's start in one of these chapters. We might cover some other wavelengths as well. But I'd love to start this conversation at the foot of a Daoist mountain. And so I'm curious for you, where were you in your life at that point in time?
One is that somewhere in my career, there just happens to be a time where I decided to do something different. So that was kind of at the end of so I told you that I've had sort of several careers. I've pivoted myself many times during my student life and during my career. And that happens to be at a pivotal time where I've had a few years on the public equity market, functioning as a fundamental analyst. And that's where, one, I was a little burnt out. So I was looking to get reinvigorated. Is that a word?
Reinvigorated. Yes, you got it right.
Reinvigorated, and have a little bit of recover. And two, I was looking to get, because a few years on with institutional funds, you kind of start to feel that dissonance right, between who you truly are and a very established institution that was kind of invented, as early as, I don't know when Fidelity was founded, maybe back in the 80s. There was a little bit dissonance, and you're looking to kind of remove yourself as far as possible from that bubble, right, or from that institutionalization, to, in a way, regain the control of who you are and where your life goes. So I think it's a combination of both that created. I just decided, okay, I'm going to take a sabbatical. I'm not going to work for however long that I did, and we'll see how things goes. And this is when kind of the seed that was planted many years ago. It's like if you had like 6 months of vacation or whatever, what's the one thing that you want to do? And going to Hogwarts was top of my list. And it fulfills all the criteria, right? It gets you physically healthy, right? And it immerses you in a completely different foreign environment that is more truthful to who you are. It allows you to explore. Yeah.
Right. There's like a natural, like physical, mental, spiritual detox of the body, mind, and soul when you go like kind of to kind of work and or train in a martial arts facility. I'm curious for you, when you had left your life as someone in public equities, was it immediately a 6-month duration? You're like, I'm going to do this for 6 months. Or was it like, I'm going to try this out for 2 weeks and we'll see where this takes me. And if I like it, I'll stay for longer. What was the self-talk that was going in your mind at that point in time?
The unit I was using at the time was actually month. I wasn't sure how many.
Uh-huh.
And I did extend my stay.
Okay. What was
my time there?
Was it a month, 2 months?
I don't remember exactly, like 1 or 2, something like that.
And at what point during your stay there did you decide, I'm going to do this for longer?
Like 7 days in.
That's a quick turnaround.
No, so you get there, right? And you're immediately immersed. Okay. So imagine you're in Hogwarts, everybody dressed like a magician, a wizard. Sorry, not magician, a wizard. And
yes,
same
you're clearly not a Potterhead. Wizard and witches.
Wizard and witches. It's a language barrier, right? So I read Harry Potter all in Chinese. So
that's fair. Yeah. That's fair. I grew up on the English version of this.
So when you get to when I got to the mountain, everybody dressed like a Daoist monk, right? With the robes and everything. You're immediately immersed. Your body feels painful and good at the same time, because the training length was, I counted like at least 5 to 6 hours per day, physical training. So
like every single day,
immediately. I think it has like a day and a half break per week. Yeah. So they have weekends.
Okay.
To recover your body. But still, your body was aching every single day, in a good way.
Okay.
Right. So
what was that like? What were the exercises you guys were doing on the mountain?
So you as you know, it's like most of physical trainings. You start with the foundations, right, which has a few dimensions: strength, stamina, and flexibility.
Yeah.
Right. So every day you start with those, and you go into martial art routines. So the routine could be a certain form of sword, or certain form of fist, or certain form of stick. So different weapons, basically. So each weapon has its own variations of forms that you can think of it as like a choreography. Yeah, think of it as a choreography. And you learn those. They coach you. And there's actually an optional morning standing meditation / Qigong.
How would you describe Qigong to people who are not familiar with? Kind of define this as breathworks?
Just think of it as meditation. It's the same. It's the same as meditation, except that the meditation we're more familiar with is like a sitting form of meditation. So you don't move, right? You sit down and you focus on yourself. But if you go to some of the Buddhist retreats or meditation work, they teach you like walking meditation, for example, right? So you meditate through a form of walking. In Daoist, in the Tai Chi kind of world, there's a very basic form of standing meditation. So you meditate by standing with a particular form. And so think of Qigong as an extension of that. So it is meditation in movement.
But is Qigong close enough to how most people would look at Tai Chi?
Yes, I would say. So if you really get into it, obviously it's complicated because Tai Chi had a martial art. So the basic form of Tai Chi had an origin of combating. So as slow as Tai Chi is, where they take the inspiration of the movement, all was for combating, right? So it was, when it was invented, it was not like slow and zen. But if you just look at what people use Tai Chi for today, I would say it's just a variation of Qigong. It's a particular choreography of Qigong.
I will be completely honest. This podcast will eventually just be completely about martial arts. I promise it will not be only about martial arts. But I'm curious, when you were there and you're training in swords and staffs and different weaponry, when you were there, do you practice all of them at the same time? Or do you eventually, let's say you're 3 months in or 6 months in, and then you eventually pick a weapon that you are most fluent in?
I like this question, but let me just address what you said before. Is like, I promise you, this episode is not going to just be about martial art. And actually, a Daoist would actually tell you that everything is in everything else. So, so let's say we talk about LP investing, right? And for a Daoist, it's actually possible to just talk about martial arts, but everything is about LP investing.
I'm usually the steward for conversation. I might need you to be the steward for this conversation of where this goes in terms of how martial arts relates to LP investing, which I'm sure there are parallels.
Because one breeds two, two breeds three, and three breeds everything. And it's just like everything goes into that one, that Dao. So Dao means the way, right? As is commonly known. And there's a Dao in everything, and everything is in the Dao. So
that makes sense.
So it's not just about drawing parallel, but really like, what is that common force, that one principle that guides everything? And so I would say martial art is just a manifestation of that Dao. And same with LP investing. You know, if you're doing it right, you are probably doing some good pattern recognition of how things actually work. And in the I'll digress to another point, is that when we were in that, you know, Daoist mountain, it's not just martial art that we learn. It's also Chinese music, traditional Chinese music, so instruments like guqin, and there are like Chinese medicine hobbyists there, and so it's a lot of skill set that was there was a fortune teller as well, right, based on I Ching, and there's which is based off of astrology. So in ancient times, Daoist was less of a religion, but it's basically just the technicians of China. So they were this branch of philosophy / religion that was specialized in like medicine, math, astrology, like just useful, practical stuff. Right. And so today, when you practice these things, they do say everything is connected. Now, I'm no good at any of these things to actually completely see it, but you do feel it. Like, for example, when I'll give you a very simple example, and you know what I mean. When you're doing Qigong or Tai Chi or martial art, they talk about how your feet should be connected to the ground, right? And actually, there's this energy that flows through, right? There shouldn't be any glitch or fragmentation. Like it should flow all the way from the bottom of your feet, right, from the earth, like all the way to the top of your head. So that's the general feeling that you're trying to grasp when you're doing these things. And when I started learning about guqin, which is a traditional, it is one of the oldest formal instruments. Guqin was played sitting down. Your posture is very much like how you're playing a piano, actually, right? But the sound quality is so different when you started to think about how your feet are connected to the ground and how you are breathing during the time when you're playing. And that I have witnessed real time. So when a guqin teacher is teaching you, right? I learned piano as a child as well. So there's a clear contrast is that after you get the basic techniques, the teacher might say something about your breathing. The teacher might say something about the flow of your energy. And it's those like very abstract things like how your feet should be connected to the ground and how the energy flows through, the bottom of your feet to your fingertip. And the sound quality immediately changes as soon as you start to think about these things. So this is how, seemingly very different skill set. In the West, a martial art and playing piano would be taught completely differently. But there's actually a very common ground. There's a common ground between these different skill sets.
If I were to draw a parallel, one thing I've noticed is for people who have been professional athletes in their respective sport, they are able to pick up a new sport and a new discipline far faster than people who have never done something as seriously as being a professional athlete. And the corollary there is there are things you pick up, whether it's discipline, ways that you think, speaking of the way, right, that cross-apply to many other disciplines. And I actually know a lot of investors who only invest in athletes, chefs, and veterans, because you've built a level of discipline in that practice to get to the top echelons of it that is equally applicable to building something new, like a new company. And so that I imagine is what you mean by there is a way that ties a lot of different disciplines together.
Yes, you got it. Yeah.
I need to go to a mountain now. So I'm curious.
I'll tell you, so many friends have gone since I told them about it.
Well, I bet you make it sound so appealing.
And every 1 or 2 years or so, I receive this random message from a friend I haven't heard for a really long time. It's like, hey, guess where I am? They send selfies between them and the shifu and the people there.
I will say, if you haven't gotten a J referral code for the Wudong Mountain, you should. Yeah. You get a QR code. It's like, here are all the folks. Here's all the disciples I'm sending your way, kind of thing.
Totally.
But that's like the capitalist mind of thinking. Speaking of which, capitalism is another way to live. It is like a cultural aspect of society that permeates a lot of things that you do across different disciplines. Daoism is just one of those philosophies to govern one's life to enact. So I want to go back to the earlier question just to scratch my own itch, but did you end up picking a particular weapon to specialize in during your time there?
To learn a choreography of a particular form, it usually takes anywhere between 2 weeks to a month, right? So during that time, actually, I tried a few different things. I learned a few different forms. And I would still say that my favorite is the sword.
Okay.
Just aesthetically.
Well, there's also, I will say, there's a difference between the sword and the blade, right? One is like a single edge, and then the other's like a double-edged sword, right?
Yes, correct.
When you say sword, do you mean the double-edged one or the single?
The double-edged one. The double-edged one. And how you use them is slightly different.
Part of the reason I think probably 90, maybe 95% of people have never even attempted the discipline, right? So that's you're already better than that.
It's very niche, yeah.
But the let's say the 5% who have attempted the discipline, most don't see it through. Most don't take the practice seriously. I'll be honest, back when I was a kid, my parents would send me to these 1 month free karate classes or 1 month free kung fu classes. And I would go. I would stay as my white belt, and for capitalistic purposes, they're like, oh, you've graduated to yellow belt. Now, I don't even think I could graduate to yellow belt, but nevertheless, I graduated to the next belt. I think most people stop there. I'm not saying that everyone only does it for free purposes, but they give up. There's a large graveyard of people who start a skill but don't see it through. Frankly, see New Year's resolutions, because most people don't see their New Year's resolutions all the way through.
And that's fine.
Yeah.
And that's fine.
So
yeah.
I'm curious for you. You're 6 months in on the Daoist mountain. Why did you decide to climb down that mountain, metaphorically and also physically? Like, was there a moment in time where you'd learned enough that you're like, I'm good, I need to go back to the society in which I came from? Or what was that?
There's a positive way and a negative way of describing it.
I'll take both.
I would say that if you're trying to tell a CV story, then it's like I was fully invigorated and I was fully recovered and I'm ready to take the next chapter or challenge of my life, right? But there's another side of the truth is that I think anxiety would drive you down the mountain.
You didn't meditate enough, Jay. You should have meditated longer on the mountain.
I was 27. Like, there's only so much meditation you can benefit from.
That's
fair. And there was the FOMO of what's going on like in real life. In the world, you feel like the world is flying every day, and you're completely cut off. And there's the anxiety about gaps on your CV. So all the things that would usually bother a 20-something-year-old was still bothering me, I would say. As much as I really enjoyed the time there, I was not as secure back then as I was today, and I would say rightfully so. So at some point, I figured that I need to get back to my career and do what I initially set out to do, is to make something of myself, right?
Was that the gnawing statement in the back of your head? It's like, I need to make something of myself, that sent you to all different chapters of your life? And I'll just caveat there also, we've talked a lot about you being a martial artist. In our pre-chat to this, I've also learned a couple things. You are also a creative writer, and that you are a published author at the age of 10, and you had so much inbound in terms of physical mails of just like fan letters effectively to you by the age of 12 that you just couldn't handle it. On top of that,
male and female, it wasn't gendered. The letters were not gendered.
I meant male as in like MAIL, as in like the letters. Oh,
male. Yes. Okay.
But male and female. Okay. Male and female, like
good. You clarified. Yeah.
Yes, I should. Sometimes you have those homonyms out there. But then by university, you were a physicist. By the graduate school, you were a software engineer. And then we mentioned earlier public equity investing. Then you became a tech executive, and now you're an LP. You've done so much in all these parts of your life. And in many ways, as I was jumping into this conversation, I was thinking, Jay, you are literally like a phoenix. You rise to prowess, and every time you reinvent yourself from the ashes of your last chapter. And so in all of this, to ask was the kind of thought of, you want to make something out of yourself, the prevalent thought throughout all these chapters, or did the motivation change across different chapters of your life?
First of all, thank you for being so kind to.
I'm
Phoenix analogy. It's the first time I heard someone using this analogy, and that's very, very flattering. Thank you, David. I mean it. I will try harder to emulate that expectation. It's a very, very good question, because the honest answer is that I don't know. I think that's the honest answer. I think I have an answer, like at any given time. Like, I have a belief of this is what's driving me. But I think human consciousness is very complex. And in reality, it probably is a combination of desire, fear, and just pure curiosity. So obviously it will make the story headline more, in a way, attractive, right? If there was one governing, dominant drive, right? So people like stories where the dots all connect and yada yada. But I feel like it's always an interplay of all these things. I think there is a strong desire of making like a perfect version of who I could be, and there's always a voice at the back of my head that's like, you know, it's a good thing but also a bad thing, right? And
what does that voice say, out of curiosity?
When you want to make a perfect version of yourself, number one, that thing doesn't exist because you're always facing conflicting priorities. Two, you become very single-minded, right? Of improving and perfecting yourself, which has consequences. Like, for example, I mentioned that I was a little burnt out, you know, by the time I went to Wudang Mountain, right? If I could do it again, I would have probably taken better care of myself, instead of just thinking, oh, like I need to be this, I need to be that. I think curiosity is definitely one. Like, if I wasn't so curious about all the things that you just mentioned, about literature, about philosophy, about how the world works, like that's the one single driver for me to pick physics as my major, was that. Like, I wanted to understand from a fundamental level how the universe works, and that goes in hand with that imagination I had of myself, right? I need to be someone who is able to explain the universe from the most fundamental level. So it goes hand in hand. But there's also just the fear of not knowing. So I don't know how to separate desire and fear. There's a fear of, I'm 50-year-old, you know, you're a mature lady, and you don't know anything. You know, you can't explain how this election is going to influence the economy next year, right? I felt like that. So when I was 20-year-old, I felt like that should be a question I should be able to explain by the time I was 50. And there was this constant fear that, like, oh shit, if I don't become an investor, or if I don't reinvent myself, you know, from a technical role, like I will not be able to understand that. So and your life is only so long, and you know, it takes like 20 years to build a company, you know, from scratch to mature, and you know how many, and that's discounting failure, right? So you fail a few times and then you may succeed, and even that takes multiple decades. And so, like, how many decades do you have in your life? So then I was like, oh, like, right, okay, I need to actually do startups now. So I think it is it is a very I would say, like, complex motivation.
Humans are completely complex, and there's beauty in all that to us. This is fascinating to me. And if I were to, like, you know, like, drill in on the complexity of human nature, and you have such a way of empathizing with folks, and I don't want that to belie the actual, like, astuteness and meticulous nature of you underwriting to LPs as like, you know, as an LP as well. But if we could now start to pivot into the topic that I know some of our audience are curious about. This is not on the agenda in which I sent you at all, but I'm curious. You are an LP, an asset allocator in both venture funds as well as fund of funds. And I also know that you are in no shortage of deal flow. In your mind, one of the greatest sells to why someone would invest in a fund of funds would often be like, they have access to certain deals, they can underwrite certain deals in ways that I cannot. What is the calculus you have, and what is the difference between underwriting to a venture fund and underwriting to a fund of funds?
If we look at the portfolio construction from today and our strategy from today's angle, fund of fund is not part of the core strategy anymore. I would say that every LP needs to start from somewhere, right? Especially if you're an individual or a family where you don't have a seasoned professional kind of setting the strategy and guiding your way. Fund of fund is a good starting point, right? And so for me, that was a starting point. Our fund of fund investments were relatively early and relatively few. And a common characteristics of our fund of fund investments is that there was amazing synergy, chemistry, and co-working prospects, between the fund of fund managers that we invested in and myself. So that was where that was why essentially and how we became LPs in some fund of funds. But as you correctly mentioned, that if you have the deal flow, you have the energy, and you have the skill to construct your own portfolio, then fund of fund obviously is more complementary than necessary by that point. I know that LPs still use fund of fund as their deal flow, or just it's more of a supplement by that point.
And so it sounds like a lot of what you do now is, I don't want to say going direct, because going direct is in some people's minds like two startups. But I mean like going direct to venture funds, because you have that access, you have that energy, and you have the know-how and how to underwrite them. And so I'm curious on kind of this question. I will say big kudos to our mutual friend, Ben, First Momentum, early guest in the podcast as well. I asked him, because I knew you two had worked with each other and knew each other well. And I was like, Ben, I have Jay coming on the podcast in a bit. Do you have any questions or comments about Jay that you think we should highlight in the podcast itself? And word for word, and I quote, he says, "Your approach is pretty unique. It's very numbers oriented," which is where the initial kind of quote came from. Yet I don't believe, and people can attest to this in earlier this conversation, where you would describe yourself as specifically numbers oriented. In fact, you are deeply methodical and deeply meticulous about all aspects, qualitative and quantitative. And if that's enough to give you a running start on all this, for those who have yet to become Jay fans, those people sending you physical mails in your inbox, how would you describe the way you think about getting to know a manager?
So in the context that you just talked about, I can totally see where that comes from, because early stage is such a qualitative thing. On the startup level and on the fund level, you have so little track record. You have so little public data. You just don't have a whole lot of quantitative aspects to work on. And added to the large variation of outcomes that is largely unpredictable, right? So if you measure the predictability of different asset classes, we have debt, we have public equity, we have private equity, then we have venture. And within venture, you have late stage and early stage. I would say early stage venture has, the wildest, even as I was just talking to a manager an hour ago, and he said, Jay, even at Series A or sometimes Series B, it is so hard for us to predict within our own portfolio, meaning that they have had, 3 to 5 years of information advantage following that startup. It's like we can't predict the outcome to anything that you would describe as accurate. So to that extent, I totally agree with Ben and most of the early stage players that it is more of an art than science. So I actually side with that camp. But I also see where that comment come from is that, compared to purely rely on your instinct and qualitative judgment, I like to apply a bit more statistics, numbers, methodicalness methods to my underwriting to early stage. And that it is a little path dependent. I would say my institutional experience with both Fidelity and Generation, both were very methodical public equity investors, had an influence on that. And even, when I was growing and leading like seed stage, Series A stage startups, there was a lot of, methodical things applied to it, like interviewing. For example, when we interview users, I always make sure that the response I get is statistically significant. If it's only one user saying that, it's not good enough. Like I need to interview 10, 20, 30. Usually when n equals 30, like you start to get some. So you see, so even it's these qualitative things you do, I have a methodical or quantitative lens at the back of my head to qualify for this, right? How confident are you with this important decision that you're making? So it's I would say it's a kind of a feedback loop between the qualitative aspects and the quantitative aspects. And to be more specific, or to a LP who play early stage venture, I would say there are 3 things you need to consider, and manager selection is just one of the 3. And you can apply a methodical framework in each of the layers. The first layer is setting up your own strategy. The second layer is portfolio construction. So what kind of how do you do your portfolio construction based on the strategy you set out to do? And then manager selection comes last. It's like within the portfolio construction target, how do you pick the managers that fit that mandate? Now, it's not external mandate, it's a mandate that you set to yourself. And I would say every layer is a combination of qualitative and quantitative. And I would say like the lower you go, so on the top layer, on the strategy layer, it's more statistical, whereas at the manager layer, it goes a bit more subjective. So should we drill down like each layer?
Yeah, let's do it.
How they play.
Let's start with the strategy layer. And I'm curious, what do you mean? Like you mentioned n equals 30 is statistically significant. I imagine you're not just assessing 30 funds before you come up with a strategy. So let's start with what is statistically significant for an LP before you come up with the strategy?
So on the strategy level, this is what I mean, is that let's say you're an LP and you're super fascinated by startups. You would love to participate in the next Google or OpenAI, right? Let's say you're like, we want to do. Surprisingly, most of the people in the world don't.
I agree. No,
I assume that your audience has already achieved the consensus on venture capital. Like that's what we want to do.
Otherwise, my podcast would be too boring for everyone else.
And actually, you have a few different strategies to choose from. You could just do fund of fund. You could put your money in fund of fund. You have a decision to make on, do you want to do all stages, just late stage, just mid stage, or just early stage, right? And let's say, because I play early stage, so like let's say you've decided I want to do early stage for whatever reason. And again, in that decision, for me, there is a qualitative and quantitative reason for that. On the qualitative side, I'm passionate about early stage. Among all the things I've done before, growing an early stage company gives me the biggest satisfaction. And I love working with founders. I love the energy between them. I like the collaborative energy at early stage. The later stage you go, 2 things happen. One is capital becomes more anonymous, because if you're Series F, right, $1 is $1. Doesn't matter, like, who writes the check and whatnot. Whereas at early stage, if it's a first check writer, it's not just a check. It's the relationship you build. It's the trust, right? It is the guidance. It's the advice. It's the spiritual support, right? Everything matters, and you want to matter. You want to matter not because of your dollar. You want to make a little bit because of your dollar, but you want to matter because of who you are, right? And so just early stage is fascinating to me. on that very subjective, like, not even rational level sometimes. But statistically, early stage also has the biggest potential to give you outsized return. The later stage you go, the more you converge to public market return, right, by definition. And if I want public equity return, I invest in NASDAQ. I invest in SP 500 with way better liquidity, right, than a Series D. So if I play venture, given that I have all these other choices of asset classes, if I were to take the illiquidity, right, discount, premium, whatever we call it, then I better be really, really compensated. And at what stage has the highest potential to get really, really compensated? Right? Early stage, because investing is down to buy cheap, sell high. Which round is the cheapest round?
That's true.
First check. Very simple. So you can see that actually it's not just the numbers. It's not just whatever you like. It's a combination of both that can form your strategy. I'm like, my strategy focuses on early stage. Mm-hmm. Right? I'll not stay within early stage. Again, as I mentioned, you could do fund of fund. So there is a brand name fund, first tier one fund out there. They have 5 to 8 verticals covered. So they have vertical teams. Each vertical has a few partners and many investors. And that would be almost equivalent. So in terms of construct, that would be very equivalent to you picking 5 different independent teams, which would be equivalent to you picking 100 independent managers, individuals. So on one hand, you can invest in Andreessen, which is a package deal. Obviously, it has a benefit of the brand and the scale and all that. But if we just look at what goes into it, on one hand, it's a one-stop shop. On the other hand, you can pick and choose. So it would be like you hired every single one of the persons into a fund like Andreessen. So I'm just saying that from a strategic perspective, you have these alternatives.
So in my mind, like how I'm thinking about it is, when you go holiday shopping at the stores and there's like the holiday gift basket, like the Christmas gift basket, the Valentine's Day gift basket. In one way, you're trusting someone else to pick the candies and the chocolates that go in the basket. There's another version where you go to the candy aisle and you pick each individual chocolate yourself and you construct your own kind of gift basket for a friend.
That's a perfect analogy. That is the perfect analogy. And obviously, each has its pros and cons because some people just don't like shopping. It's like, don't show me 100 chocolate and let me pick one. Like that's like just like, I don't care. It's too hard. I don't enjoy it. Right. Yeah. And some people love it. Some people is like, I love to go through every single one of these chocolate and pick my favorite one.
So, and try a little bit of each one, like at the Costco taste test.
Exactly. So there's no right or wrong answer. It is just about who you are. That's the qualitative bit. And the quantitative bit, the return profile is different depending on which strategy you pick, right? Do you invest a brand name fund or do you construct your own portfolio and how you construct it? So that's the quantitative part. There's obviously also the option, and I know that some LPs do it, is that do directs. So if you want to play early stage, that's a very valid strategy as well. Just do your own startups, right? So I'm just saying, so this is the first layer I was referring to. It's like, as an LP, what is your strategy and why?
Yeah. So what are if we were to just summarize some of this, what are the variables that people need to decide? It sounds like time and energy are two of those, so to speak, variables. Depending on how much time you have, depending on how much energy you have, then you might lean towards fund to funds versus you might lean towards creating your own basket. What are the other variables that people should think about?
The first is amount of capital you're putting into venture capital. That pretty much dictates a lot of things. And the ballpark I use, and obviously it's very individual, and we're not supposed to give wealth management advice.
Don't worry, I give the disclaimers on all the podcasts. This is entertainment, informational purposes only. This is not investment advice. This is not tax advice. Do what you will with all this.
Okay, so if I sing it, it will sound like entertainment, but really it's advice.
Sing it. You're a singer. You can sing this. We'll sing it in stanzas.
The way I do it, I mean, you can go more aggressive, right? Like I know there are people who do 30% of their net wealth in venture. The way I do it is that I only put the regenerative part of a wealth pool into venture. So what that means is that if your net worth is say 100 million, right? And then let's say the regenerative part, the regenerable cash flow or yield is, let's say 8%,
yeah.
right? And then, you discount inflation, you discount a little bit of like capital growth, then maybe you can put in venture capital 3 to 4 million per year, right? And that number, how much money you are putting in venture capital per year, largely dictates which game you're playing, right? If you are putting in 250K per year in venture capital funds, probably you will not be a direct investor in Andreessen or Kozla or one of the tier
ones. Your check size is too small.
So there are a few ways to do it, right? One is that you can do a fund of fund. Just put that check into a fund of fund, right? And they'll take care of everything, right? They have, right? And again, there's a quantitative side of fund versus directs. So it's all on PitchBook, but the gist, the key takeaway is that your average median of a fund of fund is higher than a venture capital fund. And the variation, so the variance, the standard deviation is lower. So it is possible for a VC fund to have 40%, 50%, or even higher IRR. It's much, much, much less likely for a fund of fund to achieve that. So, but also the likelihood of losing money is much, much, much lower of a fund of fund. So there's definitely merit to fund of fund, especially if you are capital constrained. And alternatively, you could use that capital to, let's say you have 250K to deploy every year. You can pick your own managers, right? But that also dictates that probably that means you are only investing in small scale funds, right? Sub $15 million funds. And you can comfortably do 1 or 2 funds or even 3 per year. And that give you a good portfolio. That still give you room to a good portfolio construction that is reasonably diversified. And you get to have a bit of fun with it.
What do you mean when you say reasonably diversified? And I know we're going to get into the portfolio construction part later, but as of now, what do you mean by, because reasonably diversified are like 2 semi-amorphous terms that mean different things to different people. How do you define it?
So fundamentally, from first principle, the reason why we diversify is to improve return per unit of risk taken. The reason why you can apply the word reasonable. So what I mean is the reasonable extent of diversification, meaning that you can over diversify because the benefit of diversification diminishes, post a certain degree of diversification. Let's jump into the portfolio construction part, which I was talking about, the second layer of of how we think about our LP investments. Let's say you're investing a VC fund, right? Every additional fund you add to that your portfolio does 2 things. Number 1, probabilistically, it improves your median outcome, right? So the kind of the expected return would improve as you add more fund into your portfolio. And the second thing it does is that the standard deviation / variation of your outcome would reduce. The first thing it does is that it improves your return, basically. right? The second thing it does is that it decreases your risk, right? Standard deviation / variation is a measure of risk you're taking. Right. So, and the risk goes both sides. It could go the negative side or go the positive side. So bear in mind that every fund that you add to your portfolio, you're reducing your upside as well. And that is something that a lot of people don't keep in mind. And significantly, so post a certain number of funds, it's almost impossible for you to generate like more than 2x, right? So that's what I meant, that there is a it's a double-edged sword. When you add more funds to it, you are like reducing the likelihood of you losing money, but then you're also reducing the likelihood of you having truly great return on a portfolio level.
I want to say this is written by a buddy of mine. I don't know if it's original, but I first heard it from him. But Finn Murphy, who runs Nebular right now, wrote this on a Medium blog post where he said, theoretically, the best performing fund of all time is they put 100% of their position in Google and they at the seed stage, and they held it till exit, or maybe longer than exit. In a very similar way, in terms of, I think publicly reported, I think lowercase capital fund one was like over 200x. There were some of these other ones that were like north of like 50, 80x and all that were less publicly reported. So I'm not going to mention any of these names, but as an LP, hypothetically, the best performing portfolio you can have in venture is putting it all in. I'm just going to pick on them for a while, but like all your capital into lowercase capital fund one, and naturally you'll have like over 200x effectively on your money, because I think they got in like Uber, Twitter, Square, Instagram. I think that was all in their first portfolio. But if you're like, well, you're in year 1 or year 2 of lowercase capital portfolio fund one, and you're like, well, I don't know if they're going to do well, and I want to get access to venture, and so you start investing in other funds, and naturally by investing in other funds, like it's going to pull down the average, and you're going to index closer to the venture index at large, which is probably a little less desirable than public market equivalents.
I see what you mean, but I actually wouldn't put it that way, because nobody knows if Google is going to be Google, like at the point of investing. So yeah. So from a portfolio construction perspective, agree. It's stupid to just invest in Google and nothing else.
There is a fine line between being a fool and having a lot of courage. A very fine line there.
No, if Google is the only investment you've done like ever, and then you got rich, if you were that's pure, like, that's pure luck. You were the entrepreneur, like that's a different story, right? But if you were an investor, that's pure luck, which is important. Which is important. You know, fair. Some people get, so again, portfolio construction is not an outcome-based exercise. It is a statistically based exercise, because you do not know where on the curve you are going to fall, and there's actually very little influence you have on that. You have no influence on whether COVID is going to happen, right? You have no influence on the specific things that influence your specific outcome of your specific strategy. Because by having a strategy, it just means there's a lot of great stuff that you don't invest in. And so again, I would actually distill the portfolio construction part from, you know, you can't make assumption on I'm gonna fall on this end of the curve when you do portfolio construction.
Yes, you can never do that. Like, I know the Google and the lowercase capital, they're on the extreme side of things, and they're like, you should never become an investor thinking that you'll get that.
And as I said, even after investing in Google, you know, in an agnostic mindset, like every additional position you add actually improve your return, not decrease, right? Because again, like every fund that you add could be the Google. I think that's the mindset you're thinking about it. However, on a fund level, so if I were a VC fund, there is a certain number of deals. So like every deal you add is like, you know, beneficial to your expected return. And at some point, there's a cliff where every position you add is working against you, starts to work against your targeted return. And that number is influenced by two variables. The first variable is your targeted return. So that number is very different if you're targeting 3x versus 7x, right? If you're targeting 3x, you should have a lot more positions than if you're targeting a 7x. And that number is influenced by the second variable, which is what they call a bound of a power law. So in a power law distribution, an unbounded means like the maximum. So the maximum return you can theoretically get from a startup investment is infinity. So that's what we call unbounded. And bounded means, so if it's a 100x bound, it means your assumption of the distribution curve is that any early stage investment you're doing has the potential of 100x. Right? And so what I mean is that the magic number that you should have, the magic number of startups you should have in a portfolio, beyond which the return starts to diminish, varies with these different assumptions that you make. And I usually work with a 200x. So I assume that any given startup, 500 is too high, 100 is too low, 200 is reasonable. And there's a calculation that goes behind it, which I won't bore you with. But with a two.
No, please bore us if you have the time. Like, please, not bore. Sorry, boring is the wrong word for it. I would love to learn the actual math that goes into how you arrived at 200x.
It's a very napkin calculation. So we do very early stage stress, assuming your entry valuation is 10 million, right? And assuming your exit valuation, the best company of your portfolio, you're exiting at 5 billion, right? So that's 500x right there. And then assuming 50% dilution, which can also vary, then 500x divided by 2, that's 250. But usually, obviously, you don't always enter at 10 million. You sometimes enter at 15.
So you want the average of when you enter to be at 10, and not average, but of the ones that do win in your portfolio, you want them to exit public markets or M&A by at least 5 bill.
Or the potential is 5 billion, right? So then that's where I worked out, okay, the stage we're investing has a 200x potential, and it follows a power law, right? So a few wins and most of them die, and given that, then, by the way, none of this is original. It was from the research papers. We read, and so if you just want 2x return, you can do 200 positions. It's still additive, right? But if you want a 7x return, anything more than 30, anything beyond 30 in your portfolio is counting against you, basically. It decreases your chance of earning 7x.
That makes sense. And is 7x a number you just came up with, or is there a rhyme and reason to why 7x is your goalpost?
Well, as I mentioned, obviously the 7x can translate to an IRR, but as I mentioned, that we are looking for significantly higher than public market return.
Gotcha.
Right? So 2x, that 2x, 3x is not good enough.
2x, 3x is exactly what public markets can do.
Yeah. And then what I want to remind LPs of is that the same math goes for you as well, because at the end of the day, the underlying asset you're holding, even if you're investing fund, are the startups. So let's say a fund has 30 positions, sometimes more, right? 3 funds give you 90 companies.
That's true.
Right? 10 funds give you 300 companies. And so by having 10 funds, your likelihood of achieving 7x is almost 0. Almost, right? Obviously, there are outliers. So just bear that in mind and think about so going back to your question about what does it mean to be reasonably diversified, is that it's how comfortable you are with a basically 2-3x return, which is still good. Right, it serves the purpose for majority of the people, probably.
That's true. There's an LP I chatted with probably a couple months back, maybe 2 months back or so, where I kid you not, he was an 8th generation, 9th generation family office, made plenty of wealth already. And one thing he told me of why he didn't do emerging managers is Our job as asset allocators is to stay rich, not to get rich. And because of that, our job isn't to bet on the net new shiny thing. It's not to necessarily get alpha. Our job is to de-risk beta. And so in many ways, a good bet would be a 2x, 3x bet. It doesn't have to be a 7x bet. Versus if folks are focused on getting rich, not staying rich, alpha means a little bit more to them.
That same research paper who was analyzing this portfolio construction and level of diversification said that something like concentration is how you get rich and diversification is how you stay rich.
Oh, I like that. What is the name of the research paper, if you remember?
I have it. Moonfire Ventures.
Moonfire Ventures.
Yeah, and it's on archive.org.
I love it.
Called Venture Capital for Portfolio Construction.
And so we'll include all this in the show notes, so you don't have to go searching for this yourself, but mainly needed it so that I can actually include the link later on. This is fascinating to me. So this is like how you think about portfolio construction. I want to take a level for like the last level, the third level over here, which is manager selection. And so how does one, let's say you figured out your portfolio construction, you just figured out that you want 30, let's say funds, it could be any number. How do you then take what you figured out theoretically to what you practice practically?
So once you have a strategy, and a strategy is a double-edged sword, because once you have a strategy, the hardest thing for me is to stick to the strategy.
I bet.
Because you just meet those amazing managers, amazing funds all the time, who's like not exactly at the centerpiece of the strategy. But I would say like the one thing I learned from my time at Fidelity and Generation was investment discipline. And I think that's part of the Dao actually stands across different asset classes of investing is the investment discipline. It's like once you have strategy, there's no right or wrong strategy. Like a lot of strategies can win, but just like please be consistent with executing that strategy instead of like, oh my God, he's really cool. I really want to invest in his fund. And that's yeah. If you're having fun, that's fine. But if you're after return, like that can be a bit problematic.
I agree. There's I have a good friend of mine, Eric Friedman, who I was lucky enough to work with in my last in our last company. But Eric is a phenomenal mind, and one thing he once told me when he came down to like discipline is, and the shiny object syndrome is, let's say, and he was telling me this, like, David, you're a size 10 shoe, right? And you just like to fit your shoe, you need to buy size 10 shoes. You may have the nicest looking, cleanest looking, sexiest looking size 13 shoe, but it does not fit on your foot. So no matter how great that thing is, you're not going to buy it. And so that's an example of what discipline looks like. It's like you need to buy the shoe that fits on your foot. Exactly.
And that actually means quite a few things. For example, if you are constructing your portfolio to the optimal number of funds, that means each fund needs to be uncorrelated. I think Ben mentioned that in his episode as well, right? If they're very correlated, then your diversification is not doing anything. It only is doing the bad stuff, but not the good stuff. So, and in order to do that, right? Like we are a bit more cautious on generalists. Because you don't know how correlated they are with other.
It's a blind pool of human potential, right? And so you don't know where they're
Exactly. So again, like there are amazing, truly amazing generalist funds that I would love to work with, but at least for this particular portfolio I'm talking about, then it's a harder fit. So then the idea for me is to going to back to your question on how do you select the right managers. And it's very simple. It's just like, does this guy have the right strategy for my portfolio construction? And two, does this guy look like the winner of a very, very tough game? And I would just distill to the second one, like, you know, because we talked about portfolio construction before, and now if we're just talking about of all the funds that fit your strategy, how do you pick? Does this guy look like a winner? And this is where it kind of ties back to what you talked about before, because I've tried a lot of things in my life on the operator side, and even on the operator side, I diversify, right? I've done software ventures and I've done hardware ventures, and I've managed a factory, and I was a poet, but I spent 4 years with physicists in Cambridge. So what that gives you is that you kind of get an inkling of what a winner looks like in very different contexts. Right? Because assuming if I were only a physicist, like if all I've done is physics, then I'm very familiar of like what the best physicists look like.
Yeah.
But I would have no idea of like what the best artists look like.
Yeah.
Right? If I've only done software, I wouldn't have no idea like what's the best supply chain manager look like. And they all give very, very different vibes. So I just feel like it's a muscle memory that's developed from having worked in many, many different contexts, with really good people. And then you start to kind of just develop this inkling.
Yeah. Is there a through line? Is there a through line across all the industries you've been in? Software, hardware, art, poetry, physics. Is there a through line of what telltale signs of excellence looks like from a qualitative perspective?
I think many people have written books about that. So it's a really...
Do you have one that you gravitate towards out of curiosity, like a philosophy or like a or like a trait that you look for more than others?
Yeah, it's very personal. I would say that's not the answer, but I think flow is what it is.
Define flow. What do you mean by flow?
It's just people who identify with that thing that they do.
Like the glove that fits on the hand.
Yeah, they're not doing it for the sake of doing it.
Right.
They're born to do it. You know what I mean? Like
I don't know if you've ever chatted with Raida Daouk. I think you and her would totally get along. She was on a previous episode as well. I love her to death. She runs Omcon Ventures based out of Dubai. And I think in a lot of ways, like the people who can run through walls, the people who are just destined to do this manage a fund or run their own company, are the folks that you want to back. But are there any examples of flow that you've come across? You're like, oh my God, this is a perfect fit of their past and their present and potentially their future.
I'll give an example of a portfolio manager. His mandate is deep tech, but he's college major, and his mandate is not only deep tech, but he has done deep tech stuff. He works with MIT lab, but his undergrad was something political science or something just like very humanity and quite not scientific. And then, but when I was doing due diligence on him, what was truly impressive was what I call GP strategy fit. So meaning that he works so well with scientific founders, with scientist founders. And one of the founder reference call I did, a scientist calls him like the, what do you call it? The science bro? I was like, oh, what's Joe like? And he's like, well, he's the science bro, very unwavering. Like he's, he's a very typical INTJ.
Oh, interesting.
Just
okay.
doesn't, and so one day I asked him, hey, like, do you feel you fit like on your undergrad campus? Like, was it weird for you? And it's a very like not really intrusive, but like kind of rude question because I was like, and it's very direct. And I was like, because I was like, I felt like he was destined to work. His identity, obviously finds the belonging with the science community, right? And he has done some stuff before, but like his undergrad major, it just doesn't. It's not a perfect story you can tell, right? It's not like he went to MIT for math and. So he said, nah, I didn't really belong.
That's hilarious.
And then it really opened him up, and he was talking about how, he was much happier or felt that, it clicked better when he started working with MIT lab and all that.
Right.
And you can see it was a very unusual transition, to go from, I think, public policy or something like that to to the labs. So that's an example of, the on both sides, what does it look like to not belong here, and what does it look like to be, falling into one piece.
Oh, that really makes your mind think, because I've always, me being foolhardy here, to be completely honest, I've optimized when I look at people's backgrounds, and I do try to ask a lot about different things, but I do optimize for lived experiences and people who just seem to have a natural progression in their career that eventually led to them being a fund manager today, which seems more obvious than not. But in your kind of words, or let me know if I'm putting words in your mouth, you're looking for folks where what they're doing now they were destined to do, but doesn't always have to be the fact that they did this for many, many years prior, but it just took them a long while to find their true calling.
So that goes back to the whole, scientific part, which is like authenticity to yourself. Right. The journey really is about knowing and living like who you are. And you find a lot of examples like this. So, was it Peter Thiel from 0 to 1?
Yeah.
I don't remember exactly. Like, he was a lawyer. He was trained as a lawyer, right? He went to law school, something like that. And I'm sure with his intellect, he would have been a fine lawyer, right? But so this is what I meant, because when you're underwriting emerging managers, you really are looking for that. Do you know how many emerging funds are there? Like, you really are looking at that low likelihood of success with, you need outlier success.
Right.
And in order to have, so it's not just, this person is hardworking, he's smart, he has the relationships, it really takes some, almost, what's the word? Unearthly power.
You have to will something into existence.
Yeah, exactly. Yeah. And you need to love it. You need to really love what you're doing.
Yeah. Because whether it's starting a company or starting a fund, you're starting something that has not existed ever in the world before. And there are so many opportunities for you to give up, and the world tells you should give up. But you need to convince yourself, convince your team that you need to continue pushing through, even though the world tells you, don't do this, do something else.
And with that authenticity, it's much easier to overcome.
Okay. Jay, I knew this from the beginning. You and I can go on forever. And we have gone on, and we've touched so many different topics, but maybe to come full circle here in terms of the Dao of things. And you also mentioned this earlier with the guqin, the 7-string Chinese instrument. I'm curious for you, because I'll be honest, I am close to being musically illiterate. Yes, my parents put me through 10 years of piano, and I could have done better as a pianist, but you've done a lot of instruments. And when we first started chatting, which I've never played the guqin before, but you once described when playing the guqin, which is to spell it out to our listeners, guqin. It's a traditional 7-string Chinese instrument. The music score isn't governed by a metronome or strict timing of notes, but rather the note sheet itself is purely a list of notes where the length of each is completely up to the artist, him or herself. And I'm curious for you, as someone who has achieved mastery over the guqin as well as the piano, how, if any, does the way that you think about the intuition of sound help you approach how you approach life and work today?
Thank you for such a thoughtful question. That that really speaks to a very endearing hobby of mine. I would say that it's not about the guqin itself, but it is about the contrast. Because I learned guqin when I was 27, so I was already a grown up. I learned piano when I was like 10, 11 years old, right? So piano and Western music training, and I was in concert choir, and I would say like my upbringing was in a way like musically it was quite Westernized, and So being exposed to guqin needs to be looked at from that particular context. It's like, oh, wow, this is so different. And I would say like the biggest difference is precisely what you said, is that with piano, and now pianists might not feel this way. Without the contrast, you wouldn't feel this way. That it's a lot more, I would say, dictated. It's more methodical. It's more, relatively speaking, it's more quantitative, right? Everything was written on the sheet music, the duration of a note, the height of a note. And later sheet music even has the expression written onto it, right? It goes forte here, piano here, and crescendo here. Whereas a lot of the folk tradition, or including guqin, and I would say Daoist teaching in general, it's a lot more, master to disciple. So it's a lot more hands-on and verbal and less prescribed. And as I mentioned, because of that, the flow has a lot more freedom, and it incorporates many more dimensions, including, the energy that you get from the earth. And no, you need to maintain, like the posture you maintain when you're playing guqin is very similar to that of meditation. And I would just say it's a much more intuitive approach to life. It's a much less prescribed way of living and thinking. And I think that's important, because as we talked about before, even when it comes to LP investing, it's a mix of both. It's a mix of both, like there are statistical, scientific, factual forces at play that you just have to respect. If you don't respect that, bad things will happen, right? But at the same time, so much of it is about staying truthful to yourself, staying truthful to others, and about feeling that energy, right, between you and whoever you're working with. At the end of the day, a GP-LP relationship is a 10, 15, 20, decades. It's a decade-long relationship. And so who do you want to spend time with? Who do you trust? Who will win? Like these things are very much, I would say, more on the guqin side and then the piano side.
That makes a lot of sense. And as we round out here, Jay, and I know we cover a lot of ground already, and there are many, many, many more questions I can ask you on, clearly by the questions in which I've sent you before. But is there?
Yeah, I have a lot to say as well, and we even didn't cover how do you use, because we mentioned that it's about picking winners, right?
Yeah.
How do you use quantitative methods, right, to gauge your intuition? Because honestly, these intuitions develop after 5 minutes of conversation.
Oh man, those are.
I don't know.
Yeah.
I don't know how much it speaks to our LP community that's listening to this, but really 5 minutes into a conversation,
I think we do. And then there's a thing I've been writing for a while, intuition versus discipline. And a lot of people that I've asked who have been able to get in at the earliest stages and in unicorns and all these other companies, the biggest thing they tell me is hey, you know what? You find out intuition first 5-10 minutes. The rest of us is fact checking all the intuition that you initially had. And so that's that's where the discipline comes in. You said
it. I mean, reflectively, that is exactly what happens. So I mean, I'm annoying to my GPs sometimes, because it takes me anywhere between 3 to 6 months to factual check everything.
I mean,
and everything. So I'll give you an example. If someone says, my advantage is getting to the founders early.
Yeah.
Let's say that, right? It's great. And you kind of intuitively know whether it's true or not, right? Based on just their story and whether it makes sense. But I would be okay, your angel portfolio, right? Your angel portfolio, there are 10 companies. Tell me in each individual one, when did you meet the founder? Was it before the founding of the company, before the first round of financing, or post the first round of financing? So then you can statistically count. You can be like, okay, if out of the 10 deals, only one founder was discovered, before the first round of funding, then you know that their advantage is not meeting the founders early. Not to say they don't have other advantages, but at that point, I might actually just give the feedback to the GP saying that, maybe we need to tweak our story a little bit, and that way. And I think GPs appreciate that. It's it helps to improve on the pitch.
I agree. A lot of people who do pitch use terms that could mean a lot of different things, and they use the terms rather liberally. And sometimes the prescriptive nature of which words you use is actually very helpful for them to be self-aware of how their value adds value to the ecosystem.
And another common phenomena related to this is that GPs pitch what people like to hear, not who they truly are. Again, going back to being authentic to yourself. I mean, maybe you don't get to the founders early enough, but there must be other things that you're really good at, and really discover and articulate how that thing that's unique to you helps with early stage investing. And so again, oh my God, we should starting a coaching company.
Honestly, that'd be so.
That starts with self-internal reflection, starting from those childhood stories.
Oh yeah.
Of how you become who you are today, and what you need to magnify, right, to be the best GP.
One of my favorite folks, this guy called Evan Hamilton. He's doing something new now, but he used to be at Upfront Ventures. One thing I really like about him is I forget how many pages, it's probably a 20, 40 page manifesto where he's written down pretty much every chapter of his life, from his first job to his most recent one to early childhood and all that. And it just is such a great self-reflective document, which he's also, Evan, I apologize that you may have a more inbound than you expected for who wants to read that manifesto, but he makes it reasonably public in the sense that you can learn so much about him. And I think it's a great exercise that everyone who's starting something new should do. And periodically revisit. Yes. And add, and I completely agree. Anyways, Jay, this has been so fun. As a last note, I ask this to every single one of my guests. You're obviously in quite a few places. People can find you in a lot of places. Is there a best place for people to find you? Is it email? Is it LinkedIn? Where should people find you? So my email address is, should I say it now? Or? Yes. Unless you don't want to, then we don't have to. It's jay at primitivaglobal.com. I love it. People can find it. And if you don't know how to spell Primitiva, I'd recommend looking at Jay's LinkedIn and you'll find out how to spell Primitiva. But I think it is exactly how you'd imagine it to be spelled. Jay, thank you so much. I enjoyed every second, and you're right. We did not even chat about the quantitative side of manager selection, but we'll save it for next time. Thank you for having me, David. It's been such a pleasure. And likewise, best wishes for the show. Thank you, everyone, for listening. And excited to meet more like-minded LPs and GPs. Well, thank you so much, everyone. Until the next Superclusters fan. I'm already tripping. I had so much fun. I'm already tripping. Until the next Superclusters fans, we'll see you soon. That's it from my end. Any other questions or comments you might have before we officially start recording? I'll just start with welcome to the show, and we'll dive into the first question. But any other questions you might have? No, but we can do a warm up as we do before we go on stage. Mima. Oh, I'll do it with you. You lead me. I will follow you. I cannot sing, so if I sound like a frog that's being crushed by a squeaky door, I apologize ahead of time. But I will follow your lead. Okay. Then we can do something a little easier and crazier. So you start with the lowest voice, I'm already going in falsetto. So I can tell you're a singer, by the way. I'm starting low, and I think your low matched my low, but your high went far higher than my high. I also couldn't do it in one breath. Okay, so
I do that before I go into interviews, like job interviews.
And it helps.
It's just to get your body warmed up.
Okay.
Like, cause sometimes you're mentally like prepared, but you know how like body works with your mind. And there was a famous TED talk called like fake it until you make it or something, right? So like put yourself into bold body posture, and that will make you more ready to go. So it's a similar idea. It's because you see, you're aroused with your physique.
Right.
So yeah, so that makes you a bit more active.
Okay.
Yeah.
How many times do we do? Do we do this a couple? I assume we do this a couple times, or we just do it
once?
Yeah,
you do it for like a minute.
Okay.
Do it a few times, and then and that does, increase your blood circulation.
Okay. Let's do it again. Let's do it again. I think I messed up the first time. Let's do it again. Let's do it again. Over there. It takes two to tango over here.
And then you take a deep breath, and then you go up, and then you go back down. Okay. And you can even add your. So when we were, I'll show you. So when we were in choir, like our conductor make us stand up, and then you can stand up, and you bend your what do you call it? You bend your body and go low, right?
Okay.
And then you go. So start as if you're doing a forward bending, right? And you rise. You go. So you start low, right? So go to your lowest pitch.
Okay. Oh, I feel good. This is amazing. You're the first person to do this on the podcast with me, and I love it. I feel like this needs to be a thing I do with all my guests now. What else are we missing? Okay. Is that it, or is there something else that we should have in our warm-up exercise of sorts?
I think we can start, unless you actually want to stay here until 6.
Okay, no. Right. You have a life to get back to, but this is fun. I want to give a special shout out to today's sponsor, Alchemist Accelerator. Backed by the likes of Coastal Ventures, Mayfield, Salesforce, just to name a few, Alchemist is the top B2B startup accelerator that's been around since 2012, backing founders from day one. And if you've been around for 12 years and running laser focused only on one industry, you build this incredible set of flywheels, and positive feedback loop is absolutely insane. We back the best enterprise talent who go on to change the world in which we live in, who then come back to their hometown, coach, and mentor the next generation of world-class enterprise talent. And don't take it just from me. Alchemist has backed the likes of LaunchDarkly, Rigetti, Privacera, MoEngage, FarmWise, just to name a few, many of which who have come back as mentors and coaches for the current classes of Alchemist. If you're curious and want to get more involved in the Alchemist ecosystem, check out alchemistaccelerator.com/superclusters. That's an S at the beginning and S at the end, and we'll include the link in the show notes below. Till next, stay awesome. It's David from Post here, and if you're tuning in from Spotify, Apple Podcasts, or wherever podcasts find your ear, it'd mean the world to me if you left a review. For those from the YouTube universe, let me know if you agree or disagree in the comments, and it'd mean a lot to me if you could share this episode with just one other person who'd get a kick out of today's topics. I'm on the road to publishing to at least 100 episodes of Superclusters, so every comment, question, review helps me make this experience more helpful, exciting, and fun for you. And lastly, I want to share a quick disclaimer. The views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. See you on the next.